Welcome to the Thursday edition of the Not Your Average Investor Show, where we do the JWB rental income property of the week. Today's property is at 1202 Lugar Street in Jacksonville, Florida, 32211. It is rented through 2022 with rent escalators in place, less than 5 miles from 555,000 jobs, and it plans to deliver you a sweet ROI of 8.66%. Not feeling particularly good about this Facebook live stream, so we're just gonna kick it off live in here in the Zoom room for the Thursday edition of the Not Your Average Investor Show. Today is the JWB rental income property of the week. I am your host, Pablo Gonzalez. With me, as always, the man that they call GC because of his genius concepts, because he generates cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Thank you for being with us.
We were really pulling out that that was a long conversation about running there that we were having while old Zuckerberg was keeping us nervous, but we got nothing in between us now. It is just us and you, our friends that join us, our family, our Not Your Average Investor Show community that is already lighting up the chat. We already got 40 plus people with us here today. We got the pros in here talking to us in the chat. You know that the best way to communicate in the chat is to drop down that blue box that says panelists and attendee, the panelists, and change it to panelists and attendees. So far, I see nobody that's only talking to themselves in there. But if you do, I'll let you know. And we want questions on the show, right? When we reveal this beautiful property. By the way, this is one of the prettiest houses I've seen us show up here. Like, I definitely want to live here. And if you want your questions answered on the show, use the Q&A function. There's a Q&A function on the bottom right of the screen. You pop that open. It makes it easy for me to ask old genius concepts here a question because it doesn't move as quickly as the chat button. But everybody, if you've been a part of this, you already know. And you also already know that if you want the spreadsheet that we're messing around with, go to JWBROI.com. And that is where you will download this beautiful toolkit that allows you to compare properties one-to-one. There's a lot of different funny fungible tokens people can add into your property evaluations. You want to go one-to-one. You want to make sure that everything's involved in there. Go ahead and download that spreadsheet and make it a basis of your comparison for what you're doing so that you know you got your bases covered. But without further ado, Greg, we're going to whisk ourselves off here to the magical address of 1202. I'm going to say it in Spanish because lugar in Spanish means place, right? So we're going to the spot. We're going to the lugar. We're going to 1202 Lugar Street in Jacksonville, Florida, 32211. And boom, here it is for our friends that are listening here in the future, in their ear on podcast. We're looking at a beautiful 2-story house with a brick on the bottom and another kind of siding on the top. It is $2,008, a 4-bedroom, 2.5 bathroom, 1-car garage with an estimated rent range in the high range these days of the properties that we like to look at. It's at $1,399 to $1,449 is the rent range. And what we really come to see, not just this beautiful picture of this house, we come to see this estimated conventional financing total monthly cash flow of $189 and an estimated conventional financing total ROI of 8.66%. Greg, is this a new construction house? Is this a remodel? Like what is it? I've never seen a facade like this in the stuff that we offer. Tell me a little bit about it.
This house was actually built in 2014. So it is not brand new construction. It does look like it. It was actually built by JWB and our builder, same builder who builds for us now, built this home in 2014. Been a wonderful relationship we've had with them. And so, yeah, it's not brand new, but it is very similar to how, brand new construction performs. You can even see that in the maintenance and vacancy rate expectations. What we've seen since 2014, our new construction homes have all performed according to those measurables. So very similar to a new construction home in many aspects, but not technically brand new construction.
Got it. So let's get technical. we always kick off. And by the way, we want your questions flying in. The moment you start asking questions, the moment that I'm going to talk to Gregg about it. And the best way to do that is the Q&A. I see there's a hand raised here in the chat. If you are looking to get on screen, I would love to hear from you and see what you want to say. And then we're happy to implement it and do that as well. Right. But for right now, Gregg, can you explain to us, what is this $189 a month? What does that entail? The cash flow?
Yes. So when you're evaluating rental properties, you need to look at two main metrics. And number one is your monthly cash flow. And what you're looking at here is you want to find an asset that pays for itself every single month. That's what positive cash flow means, right? You have income coming in and it more than covers all of the expenses that you will incur for the property on a normal month, including the debt costs that you take on, right? That's what people love about this asset class. You can get positive cash flow. You can get an asset that pays for itself. And so specifically what I mean though, is you take the rental income coming in each month, you subtract out your normal expenses, which would be your principal, your interest payments, your property taxes, your property insurance costs, and your monthly property management fees. No matter which way you shake it, you're going to have those costs coming to you. And so you take those away, and what you're left with in this property is an estimated $189 a month. And the big takeaway there, and what I tell people is, listen, $189 a month is not going to change your life. You know, if you're looking at this and you're saying, well, you know, $189 may be a lot or it may not be enough, it doesn't really matter. $189 is not the point. The point here is that you're investing in an asset class that is now scalable because it pays for itself every single month. Because the vast majority of folks who come into rental properties have goals that dictate that they need to buy many properties, a lot more than one. And if you have an asset class where, you know, you go negative every single month, you don't have a return on the investment every single month, it's not fun to become scalable. It's not fun to buy 3, 5, 10 properties. So when you look at $189 a month, look at that and say, wow, that is pretty cool that it's paying for itself. Now that allows me to maybe add 3, 5, 10 in the coming years and really accomplish my passive monthly income goal.
Got it. So that is the passive monthly income that one can normally expect, right? Like that is the check in the mail, but in this case, it's the electronically deposited check that just happens to be in your bank interface, because we live in the future. What is the difference between that and the conventional financing total return on investment?
Yes. So the $189 a month from the cash flow is slightly myopic, right? It's only looking at one profit center, which is your net rental income or your positive cash flow. There's 4 other profit centers. And so when you look at the total return on investment, you're starting to branch out and you're taking into account the other potential profit centers. Specifically, what you're taking into account are your tax savings and your principal pay down. Those are 2 additional profit centers. And so that's on the positive side. What you're also including are additional expenses that don't happen every single month, but that will happen to you over time. And those additional expenses will be maintenance costs, vacancy cost, another word for lost rent, and tenant placement fees. You know, when a new resident gets put into your home, there's a fee associated with that. So you have to take the good things of the additional profit centers, and you also have to take the bad things of the cost that will come to you at some point along the way. You do all of that, and you divide it by your initial investment, which is the money that you put down on the property, including closing costs. And that's how this winds up at an 8.66% estimated return on investment. Market right now is bearing between an 8 to 10% return for a passive income property in Jacksonville. So anytime we can get over an 8% return for clients, that is, of course, one that we're excited to bring to you here on the POT Dubs.
On the POT Dubs, you know, that, so all right. So that is the holistic picture of what your money is doing for you in all the profit centers, except for appreciation that you said that we have here at 0%. We're going to dive into that at a certain point, but we already got questions flying in, man. So I got to deliver on my promise here.
Let's do it.
There is a new fee in town that we haven't seen before. Estimated annual PBTS fees at $500. Paul Schaefer and Lee Bishop, both with the eagle eyes, ask, what are these PBTS fees? We have not seen these before.
How cool is it that we have such a community that has been here for a while and recognize and can zero in with the eagle eyes on something that's new? That is incredible. Wow. I'm so thankful for everybody being here every single week. And you're right, this is not one that you see on many of the property evaluations. It's not new, it just is rare, and it just hasn't been a part of the property evaluations that I've chosen for the property of the week. PBTS stands for performance-based septic system. And so one of the ways that JWB is able to create inventory in a market like Jacksonville, which is a growth market, right? One of the ways that we're able to do this is to be able to buy properties that are on small lots and build homes that then produce positive cash flow for people. Well, and if you don't have access to city sewer, right, if the sewer lines are not there, it's not provided by the city, then you have to go down the septic tank route, right? Well, normally there are lot size requirements. You have to have a certain size lot to be able to fill a septic tank or put a septic tank in that property. And many people don't know how to overcome it if you have a relatively small lot. But this is something that, of course, we solved many, many years ago. It's something that literally hundreds of our properties are on small lots. And so the way to solve that is by using what's called a performance-based septic system. It basically allows you to meet the requirements and have a fully functioning septic system in a very small lot. So to do that, there are some additional fees that come along with this. There's additional service contracts that need to be maintained every single year. And so from JWB's perspective, we want to make sure we have an understanding of what those fees are going to be and build that into the property evaluation so that when you're buying the property, it's already factored in, right? Saying it another way, if we didn't have that PBTS fee there, and if we removed it, that would jump up your expected return on investment, right? So we include it there. We make sure that you know you're going to pay it, and then we build that into the deal. As long as that can hit, of course, our 8% threshold, then we're all good. So this is an annual fee. It has already been pre-negotiated down for you, and we make sure that your PBTS septic system is serviced on an annual basis. We handle all of that for clients, and that's how we're able to create more inventory when others can't.
There you go. So another thing that's already built into the total ROI, right? So like this is just a transparency number that is where something's going. It's built into the ROI, but the cash flow is something else, right? The cash flow is just the typical month that happens. So like the year when you pay that annually, maybe that comes off of from the monthly cash flow, but when you're looking at the whole picture, it's part of the ROI, right?
Exactly. Yeah, you could even test it out, right? If you want to go over to that $500 cell and delete it, you'll see how the return on investment will go up.
Boom.
There you go.
There you go.
So again, if we're putting this in the context of where most rental property investors struggle, it's that if you buy a property like this on a small lot that has a septic tank and it's a PBTS, what are the chances that you're going to know that you have to have this thing serviced every single year? What are the chances that you're going to know what it's going to cost you, right? These are the things that turn a really great rental property experience into a poor one for our investors out there, because they just have no knowledge that this is something that's going to be required. And then every year they're $500 in the hole from a cash flow perspective because they didn't know about it early on. So, we look at it early on, prepare everybody in advance, make sure it can hit the return criteria, and then just go and perform and set ourselves up for a chance to overperform rather than setting ourselves behind the 8 ball.
There you go. Paul Schaefer has another question, and it is, that whole definition of the difference in a good question and a great question, right? Like a great question is the one that you wanted somebody to ask already, right? So
Gotcha.
we were going to talk about rent escalators, but Paul Schaefer brings it up. I'm assuming you'll cover this, but the email says the property is rented with rent escalators. I assume that's a plan to bump the rent up in the near term. Greg, can you explain the rent escalators?
Yes, absolutely. So rent escalators are a part of every lease that we sign at JWB. And we want to create a situation in a scenario where the resident can win the longer that they stay. But at the same time, we're in a market in Jacksonville where rents are rising. And we want to make sure that we're going to capture as much of that as we can while not threatening the relationship that we have with the resident. And I kind of want to say that another way. Many people love the idea of rent escalators, and I love the idea of rent escalators, as long as it does not take priority over keeping a resident in my house long-term, right? Another way of saying it, Even if I had to give up rent escalators, but I could keep my resident in the house for a very long time, I'm going to win that way because my maintenance costs, my vacancy costs are going to be a lot lower. So I think of rent escalators as gravy on top, as an added bonus, right? But we want to build those into the leases that we have with our residents. And we, of course, want to incentivize residents to stay longer. So here's what we do. For a resident, we're going to only offer them the 2 or the 3-year lease option when they rent a home with us. For the 2-year option, the first year's rent is what it is. In the second year, it's going to go up $50 a month. If a resident goes with the 3-year option, which is what we encourage, then we're going to hold the rent current and stable for the first 2 years. And then in the third year, the rent goes up $50. So it's a great way for everybody to win. Obviously, the resident can stay a long time, which is what we want. And the client's going to, and their rent is going to be held constant longer, the more of a lease that they commit to. And you as an owner of rental properties are going to really benefit as well as rents go up in future years.
Sweet. So you lock it in. You set expectations like you do with everybody else, right? Christina Rodriguez has a question. Can I receive a copy of the analysis Excel shown? So is that what you get at jwbroi.com or do we get a sample of it with this one?
Well, are you ready to dust off the brand new properties campaign that we have that actually makes that available? I mean, these are some of the most timely questions I could have even planted out there. We actually have, our team has been hard at work to make this experience on the property of the week a little better for everybody so that you can actually get this specific evaluation. Quite honestly, I'm not sure when this specific property will be uploaded, but if you go to Invest with JWB, you'll have access to all of the properties of the week with all of their evaluations. This one on Lugar Street will be up at some point here soon. And I don't know if I'm jumping the gun on my team as far as having all the evaluations up. So may check back in a day or 2 or 3 or what have you. But at some point here very soon, if you go to investwithjwb.com, you're going to get exactly what you're asking for. And you'll also get this one specifically on Lugar Street.
There you go, Christina. You know the lugar to go. So, and in the meantime, if what you want is the functional sheet, right? Like the functional spreadsheet that you can use to analyze deals, go to jwbroi.com. So Sheila Bishop has a question here. She's asking, when are we able to sell the property once we purchase?
Great question. So the first thing that I share with clients is the way to win long-term in rental properties is to plan on investing for a full market cycle. And the theory behind that is that you really can only count on home price appreciation when you invest for a full market cycle. And history shows us this. If you go back and you look at different points of time, in a real estate cycle, in a specific area, you're going to see that over 10, 15, 20-year segments, the actual average home price appreciation rate is very similar to what the historically accurate home price appreciation rate is. And so you can count on home price appreciation, but you can only do it if you're expecting to invest for a full market cycle, which is a 10 to 20-year segment. If you're only investing for a 2-year, 3-year, 5-year segment, I don't advise you to count on home price appreciation for that area. So with that in mind, your best bet, taking all the potential benefits and all the potential costs into consideration, is to invest for a full market cycle. When you come to JWB specifically, we're going to ask that you commit to holding on to the property for at least 5 years. And the thought here is that if you hold on for at least 5 years, most of the time, and maybe I shouldn't say most of the time, there is a very good chance, we feel confident that you're going to be in a position where when it goes to sell the property, you will have achieved amount of appreciation that will offset the costs that come along with selling a property, right? If you go to sell a property anytime, you're going to take 10% off the top of your sales price, and you're just going to pay those things in realtor commissions and selling and holding and closing costs. Right. So if you're going into this and you're thinking that you're going to sell in 1 year or 2 years, the only way for you to be able to sell the asset and to not lose money just in terms of those costs is by you'd have to have a ton of appreciation. We just don't think you should bank on that in the short run. If you're planning on holding on for 5 years, chances are you'll probably be okay. Right. So if you come to JWB, plan to hold for at least 5 years, and we're going to advise that you hold on for longer than that. If you're planning to sell in less than 5 years, it's not a great fit to invest with JWB. It might be a better place to invest in a different market with a different provider, because we just feel like we're not setting you up for success with that regard. But technically, you own the house the minute you buy it. If you wanted to sell it the next day, I can't stop you. I just don't think it would be a great thing for your returns.
Yeah, that's what I was going to frame. As you own the home, you can do whatever you want with it. But if they tell you it on the way in, you're going to tell them that you probably don't want. You're going to try to talk them out of investing with you, right? Because you are looking for this like long-term relationship, and you want to set people up for success.
Yes, absolutely.
Well, you mentioned something that I like talking about because it was a major eye opener for me. And it's this appreciation rate thingy that you talk about as the biggest profit center and the reason why you invest in Jacksonville. And I can't help but notice that it's here at 0%, Gregg. So why don't we talk through some of our new folks that are here that we can explain through why the appreciation rate is at 0% and what happens when we do invest long-term.
Yeah, it's all about that long-term outlook. The reason why people come to Jacksonville over other cash flow markets is because Jacksonville has a track record of appreciating more than the national average and more than comparable cash flow markets out there. If you go back from 1991 all the way to present day today, and you compare us to the 5 comparable cash flow markets out there, we've actually appreciated 34% more on average. 34% more on average than comparable cash flow markets out there. Because most of the time when you're buying rental properties in cash flow markets, they're not growth markets. They're markets in the Midwest. There's Kansas City, it's Cleveland, right? I talk about Cleveland a lot, right? It's those markets that are low price, but they don't usually grow. Population doesn't usually go there like it does when you go to Jacksonville in the state of Florida, and where it grows, population growth really happens here. So when it comes to your overall appreciation rate, investing in a market like Jacksonville has been documented to do more, but you got to have that long-term outlook. I don't know exactly how long you're going to invest. I believe very passionately that you shouldn't count on home price appreciation if you're only investing for 3 years, 5 years, whatnot. I think it's speculative there. So when it comes to our initial evaluations with all of our new clients, we don't assume anything. We don't assume you're going to hang on for 10 or 20 years. A lot of times in our discussions, we're going to find that your plan is to invest for 10 or 20 years. And then we can sort of actually build in appreciation into a profit center for you here. So that's kind of what Pablo and I will do here. For Jacksonville, our historically accurate home price appreciation rate is actually 4.3% per year on average. And when you start to plug that in, you're going to start to see some things really change as far as your total return on investment.
Plugged in, and great things are changing. If you are listening on the podcast, we just went from a 8% appreciation rate to a 24.3% appreciation rate. Sorry, not appreciation rate. 8.33% total ROI to a 24.3% ROI when it comes to conventional financing. Total ROI. Gregg, can you explain that better than I just did, please?
Yes. So when you see 24%, that is the full impact of the return on your money on an annualized basis when you take all of the profit centers into account. And that's the reason why people think rental property investing is the best risk-adjusted return on investment. When you factor in what home price appreciation can do for you, you see these returns that can be over 20%. That's why people are drawn to this asset class. It's the stability of positive cash flow with the upside of investing in a growth market and using financing effectively. So when you see 24% there, that's showing the biggest picture. Again, the qualifier though, is you have to invest for a full market cycle to think this way, right? The reason it jumped up from roughly 8% to 24% is because of the beautiful thing called leverage. And leverage allows us to use other people's money to be able to increase our return on investment. Simple example, if your market value goes up 4% and it appreciates 4% in a year, and your overall market value, let's say, is $100,000, that means that at the end of the year, your house is worth $104,000. That was a $4,000 gain on that return, right? That's a Now, but what's your return on investment? If you put all of your cash into the deal, your return on investment there is 4% because it's 4,000 over the 100,000 that you invested. But if you use smart debt effectively, and this is something that we help all of our clients with, new clients, repeat clients, everybody, we help them use smart debt effectively, you can benefit from a return perspective a lot more. And so in that same example, if the home value is 100,000, it appreciates 4% a year, it's now worth 104,000. That means you earned $4,000 of a return just from appreciation. But if you only put 25% down, that $4,000 gain is now over a $25,000 initial investment. And if you do the quick math in your phone or what have you, 4,000 divided by 25,000 is a 16% return on investment just from appreciation. And we haven't talked about the other profit centers like cash flow and tax savings and all that good stuff. So when you combine all that together, that's how you get that 24%. It's through the beauty and magic of leverage.
The magic of leverage. That is a magical thing that the POT dub brought into my life, right? Like for the first, when did we start? When did we start doing the property of the week, Greg? It was like probably around like June, July of last year, something like that, like mid-year, summer, something like that.
It was when I started listening to you. Many people don't know that Pablo is the godfather of the property of the week. He pitched the idea originally, and I was like, I don't know if we want to do that. And then I was like, that's an awesome idea, and we all have Pablo to thank for it.
Man, you're welcome. And second of all, I'm a proud godfather. And, you know, like I remember when I'd be talking to my friends, like, man, I'm working with this company. They're amazing. You know, like I'm doing the marketing for this company. They got this amazing, like investing vehicle and you get this like return and this and that. And they'd be like, well, yeah, but I can get a 10% or something here. It wasn't until we started really breaking down this like leverage point of how appreciation goes into it that I really started understanding the true competitive advantage of owning these properties and owning them outright and not just a syndication deal and not just these other like private lending kind of opportunities that rich people get, you know, like anyways, I love when we bring it up. I get excited. Greg.
Me too.
Yeah. And we got a couple of other, you know, new questions here that are great. Sheila Bishop asks, how do we get paid our monthly income?
Great question, Sheila. So it's a very smooth and seamless process. We used to call it mailbox money because, you know, the check would arrive in your mailbox. Now it's done electronically, but basically what happens every single month is JWB collects the rent for you. We hold back our management fee, which is 10% of the rents that are collected, and then we send you the difference electronically. We do it on the 25th of every single month. And now for you, and let's put some numbers to it, right? Let's say that the rents are $1,000. That's what we're going to collect from your resident for you. JWB is going to hold back 10% as our monthly management fee. So that would be $100 that JWB would earn. And we're going to make a distribution to you of $900 that would show up in your bank account on the 25th of the month. And then with that $900, you're then going to pay your mortgage payment. So you got your principal, interest, taxes, and insurance. Most of the time that's escrowed into one payment, and then you are going to make that payment to the bank, and the net amount left over after you make the payment in this property is $189. It's somewhere around there for all properties, and that's the logistical part of it.
There you go. And, you know, she's got a follow-up. Are other amounts held in reserve for expenses, or are they billed?
So when you come on board, we're going to set up what's called a maintenance escrow for you. It's $400 for your entire property. And so this is built so that you can be very passive here, right? It's passive, but you also want to make sure that there's a threshold where we're not going to, of course, spend your money without talking to you about it. And $400 is that correct threshold in our experience. So basically you come on board, part of the original money that you earn from as far as your rents is going to be held back. So $400 is also going to be held back, and it's going to serve as your maintenance escrow. In the future, 6 months down the line, if there is a very small maintenance item, if for some reason the door needs to be rekeyed or whatever, it costs $25 or whatever that costs, we're not going to call you up every single time and say, hey, here's a $25 expense. Do we have your approval to go and do it? Because it's not a good situation for you. It's not a good situation for the resident. It's not a good situation for JWB. You're basically going to trust us to act on your behalf up to that $400 threshold. And then we send you the bill. We give you all transparency that you need, the invoice, It's clearly communicated, but it's just a speed and a way to be passive, but also get your resident taken care of. Anything above $400, we must come to you and talk to you about before spending your money. And so that's why, of course, the threshold and the maintenance escrow is at that $400 level.
I love it. Great question, Sheila, right? Like, I get the sense that you come to these calls, you realize that there's probably like 10 or 15 people here that are longtime clients that are reinvesting with us, that spend a lot of Tuesdays and Thursdays with us, but there's also always new people that are coming and are asking basic questions. We very much encourage these basic questions. We really love the opportunity to explain this stuff through. What you don't know, somebody else doesn't know either, right? So I love these questions, and I love that we're getting into some like basic stuff here that, quite frankly, we rarely talk about. And I think it's a really, really good opportunity to talk about. And I do have to ask though, if you could please use the Q&A box for asking the questions, because the chat is really moving really fast. And now I'm starting to like lose track of some of the questions that are in the chat versus the Q&A. I may go cross-eyed in a second if you don't mind. But Wendy Tengara has a question, and she says, is there an HOA for this property?
Great question, Wendy. There is not an HOA for this property. If there was, you would see it as a line item on our property evaluation, and there would be an expense associated with it, and it would have been taken into account for you before you invested. So there is not one for this property.
There you go. Helen Kennedy has a question. Is that maintenance escrow held in an interest-bearing account?
No, it is not an interest-bearing account.
There you go. Speaking of interest, I am interested in returning to what we started talking about here when we first positioned this property as being close to downtown and being close to 55 million jobs. I'm just kidding. It's 55,000 jobs, right? What are these job drivers in downtown, Gregg? So this is close to the urban center, right? This is a 15-minute drive from downtown Jacksonville. What is driving these 55,000 jobs?
Jacksonville is known as a leader in healthcare, a leader in the financial district, a leader in shipping and logistics. And those are our main drivers. Military is a huge part of our economic base here. The largest military base we have has over 20,000 jobs. And so our economy is diverse. And when you look at downtown, that is the most centralized location of all of our jobs, as you would imagine. So there's over 55,000. And when you're thinking about investing in a market, make sure you do your due diligence to see what the big economic drivers are. And sort of as like a standard, you don't want to be investing in a market that doesn't have some very solid companies that are anchored there. One of the ways to check that out is to go to the Fortune 500 list. Right? It should give you a lot of peace of mind and a lot of confidence to invest in a market that is strong enough to attract some of the nation's best and most profitable and longest running companies to have their headquarters there. Right? That speaks volumes about the state of the market and the state of the economy. In Jacksonville, we have 3 Fortune 500 companies that are located downtown. We have Fidelity National Information Services, which is a payment processing leader. We have Fidelity National Financial Services, which is related to the title insurance industry and mortgage industry. And we have CSX, which is in commercial freight for commercial railways. All 3 are on the Fortune 500 list, and they're located downtown. So those are the big ones. But 55,000 jobs is a great place for us to be investing around. Now, we don't invest downtown for turnkey properties for our clients, because it doesn't hit every single category for us, right? Mainly the market from a maintenance and vacancy perspective is not where we want it to be at the moment. So we don't recommend that you actually purchase downtown turnkey investment properties. Maybe someday that'll change. We certainly hope. But from an investment perspective, we want to be investing in those neighborhoods that are around downtown, because we're 10 minutes, 15 minutes away from 55,000 jobs. And so that's why we choose those neighborhoods.
And you guys these are the investments that you sell to clients, right? But there is a lot of investment that is happening currently in downtown right now. Like, it feels like it's hitting this like critical mass tipping point. And I know that JWB is active in that in your own investments. Can you kind of just talk us through what is happening in downtown? We haven't talked about that in a while, man. It's exciting.
I love talking about downtown. Downtown, I feel like we're at a special moment in Jacksonville's downtown. I really do. I'll tell you about what we're doing about it to show you how much we believe it's a special moment here in a second. But let's talk a big picture. I pulled some stats from the Downtown Vision report. They do a state of Jacksonville's downtown every single year. And some of the numbers here, I think, really kind of accentuate the point that I'm trying to make, that this is a special moment for downtown Jacksonville. What they do is they look at how many millions of dollars of projects have been completed every single year. And what we, of course, want to see is a lot of projects completed. When you complete projects, that brings more residents to come and live and work and play downtown. It brings other amenities that come downtown. And ultimately, what that does is it increases rents downtown. And when you increase rents downtown as a developer, that gives you the ability to go in and actually make a profit by renovating or developing or building new construction buildings downtown. So that's how this whole flywheel works. So here's some of the numbers. In 2019, 2020, Jacksonville's downtown had $530 million worth of projects completed. Now, anytime you say 530 million, that sounds like a lot, right? But for a downtown, when you're thinking about multi-million dollar projects every single time, right? That number to me sounds small, right?
Yeah.
That's not where we want to be, right? We want to be much bigger than that. Well, here's where you get to some of the big numbers. We have $2.9 billion worth of projects currently underway in downtown right now. That was with a B, billion. So from one year to the next, when I talk about a special moment, that's probably the biggest indicator, right? Going from 530 million to 2.9 billion currently underway is a big jump. I don't know if we've ever had that big of a jump in any of the years that Downtown Vision's been putting this report together. But I can tell you it hasn't been since I've been here, which has been 15 years. We also have a $3.1 billion worth of projects that are proposed in the future. Now, for me, I don't pay so much attention to that number of like what's proposed in the future, because there's a million things that have to go right there. It certainly sounds nice to have another 3.1 billion in the way there, in the works there. But for me, when I see 2.9 actually underway right now, 2.9 billion, that matters. And you're seeing big players involved, like Shad Khan, who's the owner of the Jacksonville Jaguars. He's a major player in downtown development. He's got a number of projects that are currently going through city council. And you're also seeing smaller players, new guys on the scene for investing in downtown Jacksonville, which is actually JWB. JWB has bought 4 buildings downtown over the last 18 months. And we did it all in a small cluster, made a lot of news and press about it, because we absolutely believe this is, number one, going to be the best thing for Jacksonville. We believe it's a special moment in time where we can actually make an impact and be a driver for attracting talent to come and live and work down there and attracting jobs to come down there. And then long-term, we see this as being critical to protect and to grow the assets for all of you. Because if we can be a major player and influence median incomes rising and influence new jobs coming to the area, well, that's going to help everybody's risk-adjusted returns long-term. It's going to increase rents, it's going to increase home prices, and our clients are really going to win when you're thinking about what we're trying to do on a 10 or 20-year basis. So a lot of fun stuff when we think about where downtown is in the future. Today, downtown is better than where it was a number of years ago, but we are trying to bridge that gap drastically. And there's so much positive momentum now. There's actually things that are getting done and projects that are underway now at a faster rate than what they were before. But I'll kind of leave you with, one of the worst things that you could say about Jacksonville is that people talk about the potential of downtown, the potential. If you're from Jacksonville, you've definitely heard people say, "Oh, there's so much potential at downtown." I just think now's the moment where we're capturing it. We really are. You got city leaders that are on board. You got incentive programs that are aligning goals, and you got $2.9 billion worth of projects that are underway.
Man, I think back to the early days of first of all, Helen Kennedy, who's in the chat, who is new to Jacksonville. She's actually renting at a JWB property and likes it so much that she's thinking about investing in one before she buys her home, which is,
No way.
yeah. Yeah. So welcome to Jacksonville, Helen. It's awesome, right? Like I'm pretty new to Jacksonville. She says she drove through downtown yesterday and got excited, right? Like it is exciting, right? Like I'm pretty new to Jacksonville myself. I've also invested in a rental property before buying my own home here because I like the dynamics of what's happening in this asset class. But you see it as a resident, you see this like giant potential, right? Like you see this like waterfront and these streets and the history of these buildings. And it's a really like charming area that has a lot of potential. As an investor, when I hear you talk about this, I think about just how deep the vertical integration of what you do goes, right? Like the idea that not only are you a turnkey rental income property company that owns the land and the construction company and the property management and the portfolio management, but the idea that by driving strategic investments 20, 25 years down the line, you're expanding the category of Jacksonville investment, right? Like right now you dominate these 4 neighborhoods, but the more the city does, the more neighborhoods are going to pop up that are going to fit under that risk adjusted return that you're famous for. And that just continues to create the market that expands the market cap. If you're talking about it from an investing standpoint of a city that creates more and more opportunities for investors. I'm just like fascinated by the whole flywheel dynamic of it all, man. I think it's really, really cool. And I think back to the second or third interview that we had on the Not Your Average Investor show, Daniel Davis, who was just talking about this tipping point that's about to happen and seeing it coming down the line. And now it's actually happening, right? Just like a year later. It's incredible, man.
It really is, man. And I've spent so much time. Actually, yesterday I was on our group and I just started writing a post about the difference between being a turnkey company and a vertically integrated company. And the more I think about this, people are coming to me and they're saying, I want to invest for 10 or 20 years. I want to give you a certain amount of money and I want you to give me back a whole lot more, right? For a 10 to 20 year horizon, you need to be investing in a company that is doing these types of things well beyond just building a house, selling you a house, and managing your property, right? If your horizon is only 3 years or 5 years, and you choose a company to do business with in a market that just does those things, then you'll probably be all right. If you choose a company to do business with that is in 15 different markets and that's all they do, you'll probably be all right. But if you want to have the best risk-adjusted return, somebody who's going to protect your asset as well as help it grow over 10 or 20 years, they need to be a major player in the local economics and the social and political realms. They need to be an influencer. They need to be at the table when some of these policies are being made. They need to be in the know of what's happening. That's how you actually take care of somebody's money for 10 years or 20 years. And so many times people have said to JWB, why don't you guys go elsewhere? Oh, I wish you were in this market or that market or this market or that market. And I've always felt like, man, like there's like you're missing the point, right? Like if we were to go in 10 or 15 different markets out there, there's no way we could do what we do. There's no way that we could build shipping container apartments in downtown Jacksonville to explore affordable housing, to maybe figure out a way to lower build costs so maybe we can create more inventory in Jacksonville, right? There's no that we could help and be a part of the process of redeveloping incentive programs that help developers renovate historic buildings downtown, which has spurred so many people starting to buy and renovate historic buildings downtown. Right? You can't do all of that. And so if your horizon is 10 or 20 years, your assets are best protected by somebody who is a mile deep rather than a mile wide in a market, in my opinion.
Boom, drop that mic, Gregg. I love it, man. Listen, as somebody that comes from an economic development background in Miami, like I know exactly what what a thriving urban core can do to a city, right? Like it makes the home price appreciation for everybody that's already in be very, very lucrative. So, all right, let's go back. Let's get an inch wide and a mile deep now into the property stuff. Sheila Bishop asked another great question. Do we have to use your lenders when purchasing?
Yes, great question. And the answer is yes. And it is to everybody's benefit. It's to your benefit. It's to JWB's benefit. But we do require that you work with one of the lenders in our approved network. And the most pertinent reason there is that there are many lenders out there promise the world, but just don't have the experience to actually make investment property loans on turnkey rental properties in Jacksonville, Florida. And it's not the same doing it in different markets. It's not the same if you're doing another rental property versus a turnkey property. There are many rules that banks have, individual lenders have, that even the brokers or the loan officers who set you up with a loan aren't aware of, because they're deep into the underwriter world and they won't know until you get to the end of the cycle and the loan just doesn't close. So we want to avoid all of that. We've been down that route, many, many moons ago, way early on in our business. We allowed people to use lenders from other places. And quite frankly, clients hated it because they couldn't close at the same rate. Many times they'd go through 60 days of putting documents together and then the loan wouldn't close. And then from a JWB perspective, it would be irresponsible to do that, because the way we keep the lights on here is by homes actually closing. So we do require that you work with one of our lenders. We're happy to facilitate that. It's a part of our client onboard process, and we make that a pretty smooth process for you.
There you go. Mike Foster has a quick clarification question here. The current JWB online ROI calculator doesn't include the PBTS fee. Will that version be uploaded this week? You want to kind of like talk through what the JWBROI.com is versus the rental properties thing?
So for that calculator, it's totally able to be changed. That's one of the beauties of it, right? So you know how we change it on our evaluation, like the one that you just saw? And Pablo, if you wouldn't mind, I'll just kind of walk through it. Could you bring up the evaluation again real quick?
Don't mind if I do.
Yeah, where it says line 28, estimated annual PBTS fees. If you wouldn't mind just kind of zooming in there for everybody. Whatever fee you want to potentially include, whether that's a PBTS fee or an HOA or whatever other fee you may think that your property has, all you have to do is just change whatever $500 is, that cell right there, and that will adjust every other part of the calculations for you. So if there was an HOA fee and it was $500 a year, that would obviously play well here. If it was $300 a year, you could just change it just like that and then change 500 to 300. And then that would totally calculate it the way that it should as well. So when you go to JWBROI.com, you're going to see our standard evaluation, which has a placeholder for HOAs. But if you want to have that placeholder be reflective for a PBTS fee, just literally change the label and change the dollar amount to what you think it should be. And then you'll have the ability to analyze your returns that way.
I'm trying to control Z out of everything that I just did, and I think I'm like freaking out the sheet here, Greg. So I hope that I hope it's not too bad, but we're good.
I think you're golden.
Yeah. So a couple of things there, right? So JWB ROI, you get the sheet that you can mess with for whatever investment. It is manipulatable for you to calculate anything you need. The JWB, what is it? Rental? What is it? Investments? JWB rental?
It's investwithjwb.com.
Investwithjwb.com. That is where you'll be able to download all these like past property of the week sheets that will be one-to-one what we're looking at here on the show. All right. So let's move forward here. Got a couple more minutes to go. Lee Bishop says, Craig, I get positive reinforcement in my investment properties with JWB, as each month I get snail mail and email about selling my rental income properties to these investors. It is a great seat to be in and watch and be glad I'm in the Jacksonville area to invest. Can you kind of talk to the demand for rental income properties in Jacksonville right now, man? Because my phone has already started. Like I just closed on my property and I'm already starting to get calls about selling my house.
Man, I get so many calls. Like I probably get like 20 random, like I don't know which number it is, not my caller ID every single day. I get random text messages now because people text blast. And what happens here is that people, of course, want to buy rental properties in Jacksonville. It's obviously a hot market. And so when you close on a rental property, when you close on any piece of real estate, there's a certain amount of your information that is on the public record, right? Your name, the address, right? And so what all these people do out here is they basically go and search the public record for everybody who closed on a property, and then they start to send marketing out to those individuals, and somehow they find your cell phone number somewhere. So that's what they do. They do all these campaigns. They send mail out. They do automated voicemail drops and automated text blasts and all this other stuff. So if you buy a rental property with JWB, expect that you're going to get hit up, just like Lee, just like myself. It's not fun, but yeah, I mean, there's a lot of demand right now, and there is a scarcity of land. There is a scarcity of renovated properties, and people are pulling out all of the stops to be able to acquire properties. The funny thing is that, you want to know what the real funny thing is? This may make Lee laugh here. So our clients obviously close on the properties. It's on the public record. And then what these marketing companies do, they just run a blank list of everybody in a certain zip code that they may want to buy properties in, and they sell, and then they do the marketing. And so everybody who's hitting up Lee right now is basically buying in a JWB neighborhood, right? They don't know that Lee bought from JWB, but they're just reaching out. If Lee was to give those people a call, and if Lee was to actually go under contract to sell with those people, they're going to want to buy at a huge discount. So I wouldn't recommend it. Do you know who those people are then going to turn around to call and try to sell the property to?
Who's that, Greg?
JWB.
Sounds like a good deal.
I mean, they are going to come back to us because we are so dominant in those areas. We know them so well. We can pay more than the competition can for properties in those areas. So that's just why it's a giant waste of time for most people out there. But all roads would lead back to JWB for the most part, even if you called any of those folks who are trying to buy it.
Vertical integration is unstoppable. So Leo kind of says that in the chat. That's why I'm interested in what JWB has to offer. They're concentrated more in one location, Jacksonville, compared to other turnkey solutions where you have to wait for 6 months and they require your earnest deposit now. I'm encouraging my wife and sister to invest and check it out. Thanks, Leo. Yeah. Like, I mean, that's the thing, right? You're a mile deep.
That's right. If you want to talk about how you have a runway for 2 and 3 years in the future, and you're in 15 different markets, there's no way you're buying land, buying downtown buildings, developing land, figuring out other cost-saving mechanisms to be able to preserve cash flow for people 2 to 3 years, right? You have to give up something. And what many companies decide to do is to go to 15 different markets because they're in search of inventory. If you really want to make this whole thing work, you had to be thinking many, many years ago to be buying and stockpiling land. And why did we do that? Well, because we were a major influence in downtown Jacksonville. At that point, we knew what was happening, and we decided to put our money where our mouth is and buy all of this land. And you don't have the confidence to do that unless you are in the know for an area. And if you're one of 15 areas, you're not going to do that.
Yep. Makes sense to me, man. And now the chat's lighting up with people that have properties in other markets. Like, yeah, everybody's getting calls these days because the rental property market is kind of like what Wall Street is driving these days, right? So like, it isn't only exclusive to Jacksonville that you get these phone calls, but like you told me on this run this morning, right? You never run out of problems. You just seek better problems. So if the problem that you have is that you're having a bunch of people trying to buy your rental income property, not a bad problem to have. Paul Schaefer has one question here that he says he's been looking on the website, and what he's really asking is there one location where he can see all of your currently available properties?
There's not one location, Paul. Logistically, it just doesn't even make sense to create that location. Properties sell extremely quickly now. So like maintaining that list would do no good for anybody. Really, the best thing that we have found to do is to create this structure, which is the property of the week on Thursdays. And the purpose of the property of the week is not only to sell this property, right? Sometimes clients buy them from the property of the week call. Many times they don't, right? Many times the properties are actually sold maybe a couple of days in advance. But what it does is it gives you insight into the current type of assets that we have. And because JWB does the same thing over and over again, if you like the asset that you're seeing here, or when you go to investwithjwb.com and you see the last 10 weeks of properties of the week and it makes sense for you, then you get on the phone with JWB and we're going to be able to replicate that process and that property for you. It's going to have a different address, but the purchase price, the rents, the return on investment, the area, it's all going to be extremely similar. So that's the best way that we've been able to prepare clients effectively to make sure that they kind of understand what the expectations are of the returns and prices and whatnot, while also just knowing that this is a hot real estate market and that things sell quickly. And that's really the best way to do it.
Yeah, it makes sense. When I think about everything that we've learned in doing all of this, or at least that I've learned and kind of being the voice here of the customer on the show, I feel like you're not selling houses, you're selling a risk-adjusted return, right? Because you've been able to systemize it so that really what you're buying is that 24.3% if you're holding it on for the cycle. You're buying that cash flow, right? Like the idea that what you're buying into, at least what I bought into, is the fact that you've done this so many times that it is a Ford Model T that I'm buying here, not a one-off investment or whatever it may be, right? Like I'm buying a widget and I'm buying that return. And I'm not shy to say that I think it's kind of brilliant. And Lee Bishop says, "See how smart you're getting, Pablo." That's right. I do feel like I'm getting a lot smarter, man. Ryan Carlson has last question before we first of all, before we get into our last question, I get the sense that there's a bunch of new folks with us today on the show, right? Like it's great to have you. It's great to be a part of this. We have a Facebook group that is I'm going to put it in the chat here, jwbfacebookgroup.com. It has 2,400, almost 2,500 investors in there, a bunch of like really smart people that know what they're doing when it comes to rental property investing. It's the wisdom of the crowd. It's kind of like what we started this show to do, is to create this community that people can help each other. And you see a little bit of it here in the chat of people going back and forth and giving each other advice. But in the Facebook group, it happens all the time, right? So any question that you have that wasn't answered on the show, any question that you have that maybe you want to get it from somebody that isn't Gregg or me or whoever, and you want to meet somebody, I really encourage that you join that Facebook group. There's a ton of value that's being exchanged there on a daily basis. And it's our community, right? We used to call it the Secret Cool Club. No secret anymore because it's 2,500 people, but it's a cool club, right? So like, if you want to be in the cool club, come join us in the Facebook group. I'm going to put it here in the chat as soon as I ask this question. Ryan Carlson asks, what are your thoughts in the Florida market as a whole?
Well, I really kind of hesitate to really paint a broad stroke over a statewide real estate market or a national real estate market, right? Real estate is hyper local. So I think that you have so many different markets. If you think about the big markets in Florida, you've got Miami, you've got Tampa, you got Orlando, you got Jacksonville. All of those are very, very different. Jacksonville is growing at an incredible rate. Even in the state of Florida, population is growing here, mainly because if you compare it to the other markets, major markets in Florida, we're underpriced. We have lower prices. We're more affordable. So the word is catching on. But, each one of those markets has different dynamics. As you get closer and closer to Miami, typically the chances of positive cash flow go farther and farther away. I mean, if you get to Orlando and Tampa, the median home sales prices there are a lot higher than what they are in Jacksonville. So when you start to see that, your chances for cash flow become fewer and farther between. So that's kind of just a general overview of it. But I would encourage you to really kind of, if you're a fan of the show and you watch some of the metrics that we talk about, whether that's months of inventory or median home sales prices, historically accurate average appreciation rates, I would just encourage you to kind of do some of the research on those individual markets and compare those to some of the things that we share with you on the Jacksonville market.
Yeah, Ryan, listen, I'll tell you, as somebody that is pretty new to Jacksonville, coming from South Florida, I know Helen in here in the chat is also coming from South Florida as well. It couldn't be any more different, right? Like right now the news of South Florida is that all these like tech millionaires are moving there, and a place that was unaffordable for me before has become even more unaffordable. And Jacksonville continues to be very affordable to buy into. And I equate it to, I like to gamble every once in a while, right? But I don't like, when I go to the Bellagio, I'm not sitting down at the $500 blackjack table, man. I'm sitting down at the $5 blackjack table because I only come in with like $2,000 and I don't want to lose it, right? So, I see the difference in markets. I think of it in that way, right? Like there is places where, you're going to have to make these huge bets, and yeah, they may work out for you, but you're also super leveraged in that bet. Like you're over leveraged in that bet, right? Like, so you have to apply so much of your your entire investment portfolio into one spot. Whereas in Jacksonville, you're able to diversify within Jacksonville because it is a lower than average price point, right? And as it stratifies throughout the state, you find this like different mix of, right, what people like in Miami is the jobs, right? Like there is this like allure of jobs and whatever that exists in Miami that, quite frankly, I'm going to stay away from commenting on the difference between opportunities there and here that I think are pretty negligible, the difference in opportunity. But if you think about this big market that is super high priced, and then you think about a market with much lower price and similar amounts of opportunity, and you look at the different industries, right? Like Miami, I've seen has gone really high up and down because it's foreign money that's being invested, right? So it's heavily reliant on tourism, heavily reliant on real estate, and they're building out these other sectors. Whereas Jacksonville for a very long time has had these Fortune 500 companies, has had the logistics infrastructure of the port and where it sits as a distribution center. It's got a burgeoning tech scene. It's got like a really nice healthcare scene. You look at Orlando, heavily tourism, heavily seasonal, right? Like you just got to see it in all the different places. And then there's the rest of Florida. That's just kind of like these little towns that people are like, well, it's cheap, I can buy there. But like one thing happens in that town and you're really, really in trouble. So I don't know, man, that's just my take as somebody that looked at it and has been looking from the outside in and has been wondering, where can I put money? To me, Jacksonville just made a lot of sense once I experienced it through this show and quite frankly, living here as well, which is why we have the show so that people can experience it too.
Well said, brother.
Yeah, man. I don't know. I feel like I went too far there, but I like I'm kind of passionate about it, right? Like I feel like as somebody that
I know you are.
Yeah. Like I lived in Miami, man. Like I know I've looked at all this stuff from an uneducated eye. And when we started this show, it really was this whole like, dude, I want people that didn't have the resource that I had when I first invested with JWB 7 years ago to have this and like to be able to understand the differences and understand like the what this represents. And as I don't shut up about it to all my friends because I'm so pumped up about it, I see that there's like so much misconceptions out there in the market across the state, across the country, and all these different things, man. So anyways, I got pumped up. Gregg, this was awesome, man. We went a little bit over because I didn't shut up in time, but at the end of the day, great questions. We love having new people show up to the show. Thursdays is this rental property of the week. Tuesdays is interview style. This Tuesday, we got an awesome guest coming on that has been with us for this call. He's actually been here the past couple of weeks. He's a member of the community, Scott Bellotti, lives in Charlotte, North Carolina, works for Lowe's, loves his job, but wants to be a real estate investor. He got into it early last year because he saw the market going bananas, the stock market going crazy, and he wanted a safer place to put his money. I think that's pretty relevant to what's happening right now, right? Like I just took a big hit in like a wild swing in the market today. In the last couple of weeks, I wish that I would have already, I've since pulled it out. I'm going to get my second property, right? Officially, but wish I would have done it sooner. I think we're going to get into that psychology of what Scott was thinking, why he's not investing in North Carolina, why he's investing in Jacksonville. It's going to be really, really interesting. Super nice guy with a bunch of great feedback to give. So I hope that you join us on Tuesday at 12:30, same time, same place. You're already registered if you were here. Join us in the Facebook group. Download this ROI tool. It's really, really fun to tinker around with. I get to do it on a weekly basis, but you can do it all the time. And without further ado, Gregg, I will give you last words here.
Well, Pablo, congratulations on number 2. I saw Lee giving you a shout out, man. This has been an incredible journey. I think about where we started just as friends, as far as you were asking me questions about buying rental properties and whatnot, and thinking about buying your personal residence. And, it's been a really amazing thing to watch you get super excited about purchasing, not your first one, your second one now. It gives me a lot of joy to watch you do that. So congratulations. I know the whole community's excited for you. Also want to say thank you to all the new people on the show today. Wow. Really great questions. I think we had a first time that one of our residents was on the call with us. I think that is so critical because, many people don't fully comprehend that this has to be an amazing experience for the resident in order for all of this other good stuff to happen for you. They are central. They are at the core of this. We have to provide a wonderful experience that makes our residents want to be with us for a very long time, or else nothing else really matters. So super cool to have you, Helen. Thank you for being here. And just thank you guys for making this a really awesome experience. I'm really, really stoked for our conversation with Scott on Tuesday of next week. So I hope you guys will join us. And until then, we'll certainly catch up in the Facebook group. Thank you, everybody.
See y'all.